All right, I got a raised hand, so I'm gonna take that we can. So thank you so much. All right, perfect. And then I want to get things kicked off with the audio. And hopefully everybody can hear me. So, all right, I think we got the recording going. Perfect. All right, so first slide on the screen, you can see strategies to help you save taxes and get more out of your IRA. For our content today, this is more targeted for, I'll say baby boomers, but this information honestly can be applicable to everyone. If you joined our experiences before, we may have shared a lot of different stories. And a lot of my work is specializing in working with individuals and families through different life phases. A lot of the subject matter today is going to be towards or targeted towards someone who is on the back end of your accumulation phase. So if you're looking forward to that exciting transition of retirement, this is perfectly for you. But it's not to be remiss from anyone who is currently living in retirement and may have some assets that they have saved or set aside in different types of accounts. So today we're going to be talking about strategies to help you save taxes and get more out of your IRA. We'll be addressing a few common questions that typically people have in terms of, can they still contribute to a retirement account, or can they still contribute to some type of investment account, whether they're in the later stage of accumulation or if they're actually living in retirement. We'll be addressing what types of IRAs may be right for you in your specific situation. We'll be identifying when you need to take withdrawals, because there have been some changes to that age, as well as how your IRA distributions are going to be taxed. And that's applicable for anyone who has any type of retirement savings or IRA. What happens when you pass away? How are those assets passed on? There have been some changes with the treatment of inheriting retirement accounts. So everyone, if you have a loved one who may have retirement accounts, you do want to tune into that part. How to minimize tax laws, or how will the tax laws impact distributions? That's going to change as well. And how can you minimize taxes? So as you've heard through a lot of these common questions, there have been some changes, and just going to forewarn you, these aren't going to be the only changes that you ever see. So just to reintroduce myself for someone who may be new to this experience, my name is Marcus Rather. I'm a licensed financial advisor stationed here in the Richmond area. Our office is located in Glen Allen, so all of my Short Pump residents are familiar with our office. But I do have relationships with clients all throughout the state of Virginia, as well as outside of Virginia as well. And my contact information is here if you ever need to contact me, and I'll be sure to extend a follow-up from our presentation today. So just to set a preference or context for why we're addressing Savvy IRA planning, as we've experienced before years ago, many retirees, they typically entered into retirement with some form of pension, whether it's from one job or multiple jobs, or even military, or whatever the case may be. You complement a pension with Social Security, and whatever else they managed to save, and that pretty much took care of their retirement lifestyle. But in today's time, or most recently, what we've experienced, not just with the loss of pension, because most of us will now know that many jobs no longer offer a pension. They replaced a defined benefit plan with a defined contribution plan, and they put the risk on individuals saving for retirement on themselves instead of on the employer. But if we just simply look at the cost of living, right? We've dealt with high inflation now for the last 2 or 3 years, really following COVID. But we also have experienced people having higher cost of living in retirement associated with healthcare, cost of long-term care, or just regular standards of living. So when you compile all those different moving pieces together, life's become a lot more complicated for the person who's looking forward to retirement, or now currently living in retirement, whether they do or do not have a pension, if they're looking to coordinate benefits with their savings and Social Security, or just the increase in cost of living. The challenges for retirement are a lot higher. So we look at longevity, right? I know the common assumption is way back when someone was retiring and taking Social Security, that they weren't going to be living long. But that's somewhat of a myth, actually. People who were entering into 65, even 20 years ago, had an average mortality of the mid to late 70s or early 80s. So looking at today's time, if we're looking from, again, the Social Security perspective, I know we're talking about IRAs, so why am I mentioning Social Security? But statistically speaking, for those who are approaching the age of 65, whether they're individual male or female, or if they're a married couple, the likelihood or the chance of them reaching an age of 80, 85, or 90 are still relatively high. And again, this is starting from 65, not just from birth. So someone that's turning 65 or maybe a little bit older than 65 for a male, the percentage, they have a 53% chance of reaching the age of 85. A female has a 64% chance of age 85. And if you're a married couple, one of you has a 83% chance of reaching the age of 85. If we simply just extend that to 90 or 95, again, for women, typically the percent chance that they can make it to that age is a bit higher than for men. So all this is signaling or identifying is that the chances of you living a long life in retirement are reasonably high. And that's going to put more of a strain or a responsibility on the extra savings that you have for retirement to make sure that that can sustain or last you to afford your standard of living. So for many people entering into the latter part of their accumulation phase, whether they're empty nesters or someone that's approaching retirement, there are a few different opportunities that you have for additional savings. So now boomers have an additional opportunity to save discretionary assets or income, whether it's due to paying off a mortgage or approaching the ability to pay off a mortgage. If you're now an empty nester and you're no longer, affording or paying for a child's education or any other expenses associated with raising a family, with the decrease in those expenses, now you have an inflow or excess ability to save extra towards retirement. So there are many different types of vehicles that you could put money into, whether it's employer-sponsored plans, IRAs, businesses, whatever the case may be. But focus here is just the ability to save extra with a decrease in some of those expenses, which, children are expensive. So mom and dad, if you're watching, thank you so much for having me. Traditional IRA basics. So we're going to focus first on the regular old-fashioned IRA. The reason I believe they called it traditional is because when they introduced Roth IRAs somewhere in the late 90s, I believe the bill was passed in 94, and Roth IRAs became a thing in 1996. So where there was the new addition of Roth that then made the old-fashioned or traditional IRA. So what to know about traditional IRAs? One, the T stands for today, and that's all in the tax treatment. So the money that you typically put into some type of traditional account, whether it's a regular 401k, a regular 403b, a thrift savings plan, 457, or again, in this sense, an IRA. If it is a pre-tax contribution, you get your tax benefit today. So money can be contributed to these pre-tax accounts, and they can reduce or be used as a tax deduction. That's the first bullet point there. Contributions may be tax deductible. The other advantage that you have with an IRA or some other type of employer-sponsored plan is that the money that grows or that has accumulated grew on a tax-deferred basis. So you generally would not have been paying taxes on the money that's grown in these types of vehicles. But when you go to take money out, when you're withdrawing money from a plan or a traditional IRA, you will have ordinary income tax that are due. So withdrawals are generally added to your total taxable income. Now that little asterisk down here at the bottom, please keep in mind, if you're someone who's 59 and a half or younger and you're taking a distribution from these types of accounts, there likely will be an additional 10% penalty on money that you withdraw from any type of traditional IRA or regular 401k, 403b, or employer-sponsored plan. Now, the contribution rules, so they have increased the contribution amounts. So this is for 2024, and now that we're past the tax filing deadline for 2023, unless you filed an extension, you're likely going to be abiding by 2024 contribution limitations. So for traditional IRAs, the maximum amount anyone can put in is $7,000, and that's from January up until your tax filing deadline of 2024, which generally will be April of 2025. So from January until the tax filing deadline in 2025, you can put in $7,000. And for anyone who's older than the age of 50, there's an additional $1,000 catch-up contribution, meaning you can put $8,000 into an IRA, during that same time period. So anyone younger than 50, 7,000 is the maximum amount. Anyone older than 50, 8,000. Now, the asterisk here is that you must have compensation, which generally would be W-2 wages, earnings, salaries, tips, commissions, some type of earnings. You must have compensation in order to make a contribution towards a traditional IRA. One last valuable thing to understand is that now there is no age limit to make a contribution towards an IRA. Previously, before the Secure Act passed in 2019, there was an age restriction for those that could contribute to an IRA. That age was known as the 70 and a half. Since they've extended the required minimum distribution age from the Secure Act, they actually eliminated the age for who can put money into an IRA. So now the biggest thing to know is that you must have earned income. So if you're someone who is retired and you do have extra earned income, whether it's from minor jobs, part-time jobs, that those earned earnings can be contributed towards an IRA. But if you're someone who's simply just retired, drawing a pension, drawing Social Security, no other source of earned income, then you wouldn't be able to contribute to a regular IRA. Now, understand with those contribution limitations, there are also phase outs, because previously I said contributions can be deducted, and you have to have earned income in order to make a contribution. But not everyone will be able to not just contribute, but also deduct those contributions from their earnings or from their income. So these are the two stipulations. In order to be able to deduct your contribution, you and your spouse, or correction, if you and your spouse are active participants in an employer-sponsored plan, and if your income exceeds a certain threshold, then you will not be able to deduct the contributions you make towards a traditional IRA. I'm going to try to repeat that again. If you and or your spouse, if you're married, filing jointly, or if you're single, with whomever, if you are covered by an employer-sponsored plan and you're a participant and your income exceeds a certain threshold, then the contributions that you would make to a traditional IRA may be limited on what you can deduct. Biggest suggestion there, if you have a tax professional, if you have any immediate questions on your immediate or your specific situation, schedule a consultation with myself. I'll be able to identify or point out that limitation. So switching gears to the Roth IRA. Saw a great question there. I'm going to try to answer that another time. Switching gears to the Roth IRA. So Roth IRA basics, there are no deductions for contributions. So where the traditional IRA allowed you to deduct those contributions from your earned income, Roth, the R would be for retirement. So the tax benefit of a Roth account, whether it's a Roth 401k, a Roth 403b, a Roth TSP, a Roth IRA, anything Roth would give you a tax-free benefit in retirement, R for retirement. So Roth IRAs, they are not tax deductible. The savings grow the exact same. So there isn't any difference in the growth of a Roth account or a traditional account. They're both growing on a tax deferred basis. The contributions, however, are going to be what is the difference between a traditional and a Roth. Contributions can be withdrawn at any time, tax and penalty free, after 59 and a half. I don't know why we missed that part. Qualified distributions may include earnings and are also tax free. So actually that's the difference. Whatever you put in that contribution, whatever you put into a Roth IRA can be withdrawn at any time, tax and penalty free. That is a fact. Earnings. So notice the difference between what you contribute and what's earned. Earnings after 59 and a half may be tax free. So keep in mind the age 59 and a half, and you must also own the Roth IRA for at least 5 years. Contribution limits for the Roth IRA, they're the same as the traditional IRA. The maximum contribution for 2024 is $7,000. Same time frame for the traditional IRA as I mentioned before. And if you're 50 or older, you can actually do $8,000 instead of $7,000. So there's an additional $1,000 catch-up contribution that can be made towards a Roth IRA. Again, you must have compensation, generally earned income. There is no age limit for who can contribute to a Roth IRA. However, there are income limitations. If you're a single filer who's made more than $161,000, and I believe that's modified adjusted gross income. If your modified adjusted gross income exceeds $161,000, you may be ineligible to contribute to a Roth IRA. Doesn't mean you can't contribute to a Roth employer-sponsored plan, but a Roth IRA, there are earnings limitations. For someone married filing jointly, if that total joint income exceeds $240,000, again, contributions towards a Roth IRA may not be admitted. We'll take a quick pause. I saw a question. This question read aloud says, what about real estate earned money? Would real estate earned money be considered as earned income? For this presentation, I would say it's better to consult with a tax professional on that question. I'm more than happy to reach out individually, or if you consult with me, we can take a deep dive into what the IRS constitutes as earned income. For now, I just say we need to do more research on that question, but thank you for that question. All right, sticking with contributions, spousal IRA contributions. So if you find a predicament or a situation where one spouse is working, but the other spouse is not, you still are able to make a spousal contribution. So it allows the working spouse to make a traditional or Roth IRA contribution for the non-working spouse. The non-working spouse must meet all other qualifications for an applicable IRA. So again, main premise there is that there has to be earned income from the working spouse in order for a spousal IRA contribution to be made. Just to backtrack, because I imagine this is probably a question some may have, those IRA contribution limits are aggregate. So if you're contributing all of the $7,000 or $8,000 that you can towards a traditional, no extra money can be added towards a Roth IRA for that tax year. So the $7,000 or $8,000 limit of what you can put into a traditional or Roth are in total. So if you split 8,000, easy number, 4,000 to a traditional, 4,000 to a Roth, that would be permitted. But you cannot, for one IRA, for one person, make 8,000 towards the traditional and 8,000 towards the Roth. The 8,000 is in total between both traditional and Roth IRA. Great question here. Is the max contribution to a Roth IRA applicable to rollovers? Can rollovers exceed this amount? That is a great question. I'm going to answer that now. Understand the difference between the type of contribution, right? A contribution is typically earned income. That's limited. A rollover, it doesn't have a limit on how much can be rolled over. So identify the two different sources. A contribution, money that's contributed after earned income, has a limit. A rollover, a movement of money, generally doesn't have any type of limitation on the dollar amount. So thank you for that question. We're going to address that a little bit later. So what's the difference? You know, how much can a $7,500 per year make a meaningful difference? This is specifically for someone nearing retirement. On simple math, what we're looking to illustrate here is if you were contributing $7,500, which was the previous maximum for 2023, clearly the maximum is now higher for 2024. But if you were someone who was 55 and you're looking at 65, contributing $7,500 per year, over 10 years, simply the $75,000 that you would be able to save. But with compound interest, right? Clearly, we're not simply just saving and investing money to not have a rate of return. Saving $75,000 over 10 years with a rate of 6%, by the time that you reached 65, you would have had in excess of 100,000. Now, the reason we're showing 15, 20, 25, 30 years is because depending on the location of where that savings goes, your ability to hold those monies to be used at a later date in your retirement really makes a big difference. So here in this illustration, we're just showing $7,500 per year over a 10-year time period, growing at 6%. What would that grow to over a certain period of time? And you can see over 30 years, even if you only saved for 10, $77,500 saved in 10 years over 30 would have grown close to $350,000. So premise here, take advantage of any type of IRA or employer-sponsored plan. Again, employer-sponsored plans, they have higher limitations that you can see at the bottom. For 2024, anyone who's participating in a 401k or a 403b, a 457, the TSP plan or some employer-sponsored plan, the limitation is $23,000. So you have a higher contribution max through an employer-sponsored plan than you do an individual retirement account. And if you're older than 50, you actually have a higher catch-up contribution amount as well. For the IRAs, that catch-up contribution was $1,000. For employer-sponsored plan is actually $7,500. So if you're still working, you want to check to see what your retirement plan offers. If you do not have a covered plan, you definitely want to take advantage of the maximum amount for the IRAs. Or if you just have extra spending, you can take advantage of both. Now, for someone who is approaching retirement, or if you happen to change jobs, you do want to be familiar with the rollover options for what you can do with those monies. So again, it's not just people who are entering into retirement. If you've had to change a job, change a career, and you have multiple employer plans, you do want to be familiar with all of your options. So first, number one option is pretty much what you may have done in the past, just simply leaving it there, right? Leave your employer plan assets in your existing company retirement account. There are pros and cons to each of these options, but that is option number one. Option number two could be just simply rolling it from your previous employer plan to your new employer plan. That could be one good way of just consolidating the assets, giving them the ability to be added to or contributed to. Option three would be rolling it out of the employer plan into your own individual retirement account, whether that's a regular traditional IRA, or if you're rolling money from a Roth plan to a Roth IRA, you do want to be sure that you roll them into the appropriate type of IRA. Option four would be taking a lump sum distribution from your retirement plan. Again, if you're underneath the age of 59 and a half, that may incur a tax penalty. And again, if you're withdrawing money from a pre-tax account, you may have taxes that you owe on that distribution. Option five would be converting your plan assets to a Roth IRA. I'm not going to spend too much time on that now because we'll be addressing that on the back end. Or number six would be make an in-plan Roth conversion of your plan assets. So the difference between number five and number six, converting to a Roth IRA versus converting to a Roth employer plan, i.e. 401k or Roth 403b, Roth TSP, whatever the case may be. So those are going to be your six options with what you can do with your employer-sponsored plan. This is a great question here. I'm actually going to address that now since we're shifting gears on the next slide. If you leave it in your existing employer account, do you have to pick up administrative costs usually paid by an employer? That answer is going to be it depends on the employer plan. If your employer covers those costs, then generally you will not pay those expenses. If your employer does not cover the administrative costs for your plan, then yes, you will incur those expenses. So speaking on taxes, taxes is a whole nother thing in itself. It really does apply a lot towards IRAs as we're talking about contributions and distributions. The bigger picture to understand here is that historically, tax rates today are lower than what they have been in our history. As you can see in 2017, if you remember the Tax Cuts and Jobs Act that former President Trump had implemented through his administration, they decreased the national federal income tax rates. But those changes on the personal side of taxes were only temporary and are due to sunset in 2026. So the tax overhaul not only impacted personal taxes, but it also impacted business taxes as well. The business changes are more permanent. The personal tax rates are subject to change. So somewhere in the next few years, we are subject to see some type of change, whether we simply revert back to our old tax rates, which would theoretically be us going back up in tax rates with some other changes to the tax code, or we could see a revision to stay at our current tax rates for a bit longer. Just understand that our current tax rates historically are low and lower than what they have been in the past, but they are subject to change. So a few side effects of IRA distributions. Remember, withdrawing money from pre-tax accounts, again, that traditional IRA, those traditional 401k, 403b, and other employer plans, they are added to your taxable income. So you do want to be familiar with distributions coming from a retirement account and being added to your total income, because those distributions can do things like increase your exposure to the surtax on net investment income. They can phase out deductions on tax credits as well. They can also impact those who are in retirement and on Medicare. For higher earners in retirement, distributions from retirement accounts may add your total income, and the total income exceeds a certain threshold, you may have a additional payment that's required on Medicare Part B premiums, also known as the IRMA. They can also increase the amount of taxable Social Security benefits, depending on all the total income that you have for your retirement income. They can reduce or eliminate financial aid for a child's education, since FAFSA looks at the total earnings or total household earnings for those FAFSA filers. You do want to be familiar that distributions from retirement accounts can add to your income, and that can also impact your aid for student loans and things along those lines. So for required minimum distributions, this is one of the larger changes that have recently taken place. Please, everyone on the call, know that 70 and a half is no longer the age for required minimum distributions. Although there is one tax savvy strategy that you have at 70 and a half, which are called qualified charitable distributions. For today, we're just focusing on required minimum distributions. So what they are, it's the age at which you're required to make a minimum distribution, in the name, from any pre-tax qualified plan. So whether it's an IRA, whether it is an employer 401k, 403b, TSP, whatever the case may be, when you reach this age, there's a requirement that a minimal amount is required to be drawn every year that you own those assets. So avoiding IRA withdrawals, they do allow your account to grow, right? But we know with regular traditional accounts, there is a time frame for when you're required to start taking minimum distributions. So you can't avoid withdrawals forever. Now, these are the changes. Depending on the year in which you were born, if you were 72, or if you were turning 72 prior to 2022, your required minimum distribution age likely would have been 72. So if you're someone who is already drawing distributions because of required minimum distributions, your age is the same. But for those who have not or did not turn 72 in 2022, the new required minimum distribution age is now 73. So anyone born from 1951 until 1959, your required minimum distribution age is 73. Meaning in the year that you turn 73, you will be required to take a distribution from those pre-tax retirement accounts. Notice I mentioned pre-tax retirement accounts. For those born 1960 or later, your full required minimum distribution age is 75. So in the year in which you turn 75, for those born 1960 or later, that is the age in which you're required to take a minimum distribution. If you happen to miss a required minimum distribution, say you went the entire year and failed to take a distribution, you may face a penalty. Now, the penalty used to be 50% of what was required to be withdrawn. So if you had an RMD of $1,000, the penalty for not taking the distribution was 50% of the 1,000 or whatever was not withdrawn. So if you took half of the RMD and you didn't take the other half, the penalty would have been 50% of what was not taken. Now the penalty is 25%. So they eased up a little bit on the penalty. So for any required minimum distribution that was not met, the penalty is now 25% instead of 50. So these are some of the major changes that are part of the Secure Act 2.0 that was recently passed following 2022. So how do you calculate your required minimum distribution? Again, one is the age, so the year or the age in which you're required to take the distribution. Essentially, they have what they call a life expectancy factor. So just a quick illustration for those turning 73 or 75, you can see the factor for those years. As an example, if you were somebody turning 73, you would take your account balance based on the prior year, i.e. December 31st, 2023. You would look at your account balance at that point, divide that into the factor, and that will tell you how much your required minimum distribution is for 2024. So as an example, if your IRA balance is $200,000 and you were turning 75, you would take 200,000, divide that into 24.6, and that would essentially tell you what your R&D is. So mathematically, that should be $8,130.08. So that person's required minimum distribution for 2024 would be $8,130.08. Mathematically, by percentage, you can roughly equate that to about 3.7%. And you can see as you get older, the percentage in which you're required to withdraw gradually increases, so much so that essentially you will be starting to deplete those pre-tax retirement assets. You'll be withdrawing more than theoretically what may be growing year over year. So just know that your R&Ds are calculated based on your age, the factor in which your age is, and the year-end balance from the year prior. So a few mistakes that people make when it comes to taking required minimum distributions, try to keep this as simple as possible. One is aggregating RMDs between different account types. What this means is if someone has an IRA and say someone still has money in a 401k or their previous employer, you may think, hey, I know I need to take distributions. I have a distribution amount for my IRA and I have a distribution amount for my employer plan. I could easily just take it from one account and everything will be fine. That's not the truth. If you have separate types of accounts, again, IRA and employer-sponsored plan, you're required to take a distribution from both. Now, if you have multiple IRAs and not an employer-sponsored plan, then you may be able to aggregate that for one person. So if you have 2 different IRAs, 3 different IRAs, you may be able to aggregate required minimum distributions based on the IRAs. But if you have multiple employer-sponsored plans, an old 401k from one company, an old TSP from the military, and an IRA, you're going to be required to take distributions from each of those accounts. So please be familiar with the R&D rules for those specific types of accounts. The second common mistake is aggregating the R&Ds based on spouses. Both retirees, both 73 or older, 72 or older, they both may have their own retirement accounts, which means they both have their own R&D amounts. One person may think, well, we share money, right? We both have an R&D that we need to take. Let's just take it all from mine and leave hers alone, or let's take it all from mine, let's leave his alone. You're not allowed to do that. Each individual is required to take their own RMD. So you're not eligible, or you're not able to take in what they call an aggregate RMD. One person can't take a distribution for 2 people. And common mistake number 3 is simply forgetting to take the RMD and doing nothing about it, meaning you forgot to take it and you just never take it. You're generally going to continue to pay a penalty for any RMD that you don't withdraw. So pausing for questions. How's the minimum distribution calculated? Hopefully we answered that for you. If you have any other questions, thank you, I've covered perfect. If you have any other questions on that, again, one-on-one opportunities are available for me to address those. So getting into the tax savvy strategies, trying to keep it moving here. So strategy number 1 would be holding off on taking IRA distributions. So if you're entering into retirement and you're thinking to delay drawing delay drawing your money from a retirement account, that could be advantageous, right? It is a way to save on taxes because you're continuously deferring that balance until later. So one humongous advantage to that, and one big advantage to them extending the RMD age, as we mentioned before, the likelihood of someone living longer into their retirement is a lot higher. So if you need that money to last a longer time, they are allowing you more time to allow that money to grow. So holding off on taking distributions can work out to your benefit because it just allows more time for your money to grow. Keeping IRA income off your tax return for as long as possible. So you're just, deferring those taxes as well. And you're avoiding the potential side effects of taking distributions like triggering IRMA for Medicare, disrupting FAFSA filing for, student loans for minor children, or any other things that we previously addressed. Now, to every pro, there is a con. So while those are advantages, there are some disadvantages. So again, as your account balance grows, what you owe Uncle Sam will also grow. So there's a good pro and con there. Again, at 73, you generally must begin taking RMDs. Again, you can't aggregate RMDs from IRAs and employer-sponsored plans, so you may have to be withdrawing from two different buckets. IRA distribution in future years may be higher. So the more money that you're withdrawing, the more taxes that you're paying. The more taxes that you're paying or the more income that you show, you may be bumping up potentially into a higher bracket, depending on other sources of income. And then the other side effects that may not now be an issue, but may be an issue later on in retirement. Again, IRMA, the income adjustment on Medicare Part B and Part D premiums, and always the uncertainty that tax rates may be higher. As I mentioned before, we're currently in lower tax rates than what we were in years prior. Those are due to sunset in 2026. So we could see a reversion back up to higher tax rates in the future. So strategy number 2, if you're not thinking of waiting to draw money out, maybe you're thinking of converting money from traditional to a Roth account, whether it's traditional IRA to Roth IRA or a traditional account to a Roth account. So IRA or similar retirement funds are moved to a Roth IRA. Understand, by moving money to a Roth, you are paying taxes in that year. So in this example, we have Miss Jill, beautiful Miss Jill. She's going to convert $100,000 from her IRA to a Roth IRA. Now, Jill will have to add that $100,000 to her income and everything that comes with that. So adding $100,000 to her income, it may bump her up into another bracket. It could show total income that could impact Medicare premiums. It could also adjust any tax credits as we've seen before. Now, the conversion income will be taxed at Jill's total income rate. Now, the advantage to this, because she's paying the taxes on this today, now she's allowing that $100,000 to continue to grow tax deferred and eventually be able to be withdrawn tax-free. So remember, Roth IRA distributions, you have to own the Roth IRA for at least 5 years. And after 59 and a half, all distributions from a Roth IRA are tax and penalty free. Now, if you're older than 59 and a half, the amount that you convert can be distributed at any time tax and penalty free as well. So we're looking at the future of distributions from this standpoint. Converting money from a traditional to a Roth, you are paying taxes on that today, but essentially you're allowing that money to be withdrawn tax-free at a later point in time. Now, back to that conversion, we talked about contributions. I'm throwing a lot of jargon and definitions here. Contributions are what you can put in. Rollovers are money that you're moving from one bucket to another. A conversion is something different. So remember, conversions, they do not have an age limit. So anyone, whether you're nearing retirement, in retirement, later in retirement, there is no age limit to who can convert money from a traditional account to a Roth account. There's no income limitation on who can convert. Remember, contributions, you generally have income limitations. Rollovers, you don't have income limitations. Conversions, you do not have income limitations. And there's no requirement of earned income. So if you do not have earned income and you have money in a traditional type of account, you still may be eligible to convert money to a Roth IRA. So just understand the difference of contribution, rollover, and conversion. Right now, we're talking about conversions. So what can Roth conversions provide? They can help reduce the risk of rising rates. As we said before, rates are subject to change. I don't know what the change will be. Some can guess that rates will be higher. We may have to go back to higher rates because of a lot of stimulus and a lot of things that are going on to fund Social Security and Medicare and all the other things. You can guess that rates will be lower. So a way to stimulate the economy, lower taxes, higher, more spending to help accelerate opportunities to save and invest. The future tax rates are unknown, right? And they're a major concern for many retirees. So converting money from traditional to Roth can be one advantageous thing. They can also help you manage other costs tied to your income. Again, the tax treatment on Social Security and other benefits, or your Part B Medicare premiums in your future retirement may be lower from withdrawing money from a Roth type of account. Roth IRAs, they do not have required minimum distribution. So that's the other valuable part of not just converting, but having Roth assets in your retirement. Traditional types of accounts, again, traditional IRA, 401k, TSP, etc. Those assets that have not yet been taxed are going to come due. Money that you already paid tax on, current tax law, Roth IRAs do not have a required minimum distribution. So you get to decide when you want to take the distributions from a Roth type of account. So whether that's earlier in retirement, mid or later in retirement, you get to choose when you're ready to take those distributions. All the while, you're still allowing your money to grow uninterrupted and growing tax-free for however long you want that money to grow. And not just for your life, but think of how people will inherit money. If you're planning to leave money to a significant other, or if you're leaving money to a child or grandchildren, leaving Roth assets can still be passed on tax-free. How they receive it, we'll talk about in another few slides, but the tax treatment on Roth assets are always going to be tax-free. So I want to just pause for a few questions, see if I can answer these. Taking the RMD, does it have to be monthly, quarterly, or yearly? Does it matter, especially when knowing there may be a 25% penalty? So this question was about how can you take the distribution? From an IRS standpoint, they don't really care how you do it. They just want to make sure you do it in the year. So you can take your R&D on a monthly basis. The total amount, you can take it based on a month, a quarter, or once a year, whatever works for you. IRS simply just cares that you take it in the applicable year. Second question, if you're paying taxes up front on a Roth and then withdraw before the 5 years, are you paying taxes twice on this money? Great question. I'm going to try to re-emphasize these words. Contributions, money that you contribute, can always be withdrawn from a Roth IRA without tax or penalty. Money that you put in, because you already pay taxes on it, can always be withdrawn tax-free. The earnings, the money that grows on top of the contributions, that's typically what's subject to a tax or a tax penalty. So the earnings, if you take earnings out prior to 5 years or 59 and a half, those earnings may be subject to a tax or a penalty. To avoid all of that, if you own the account for at least 5 years and you're older than 59 and a half, after that, everything's tax-free. All right, so great questions. We're going to keep it rolling here. So Tax Cuts and Jobs Act, there was a big change, as I mentioned before, following 2017. The Tax Cuts and Jobs Act, they eliminated recharacterizations for Roth IRA conversions. So what this is simply saying is if you convert money from a traditional to a Roth, you can't undo it. Simple as that. That's pretty much the premise on that. So if you're stuck with your conversion, again, if the tax bill is higher than you thought, that's unfortunate. If you accidentally phase yourself out of a credit, if investments drop in value after you convert it, just know that converting money from a traditional to a Roth is more of a permanent decision. That is subject to change, again, if we revert back to the old tax code. 3 key questions before converting that you want to analyze if this is part of your plan. 1, do you have a rough idea of your conversion's impact on your tax bill? This is where we complement working with a tax professional, your tax professional. 2, do you have a plan to pay the resulting taxes from the conversion? And 3, do you have a reasonable expectation that benefits of prepaying your taxes like this make sense in your overall strategy? So again, allow us to work with your tax professional in identifying those answers. So those are questions that you generally want to ask. Essentially, what we're talking about here is filling up the bracket. Again, we look at tax brackets from an earned income standpoint. What we try to avoid with converting is bumping you up into another bracket. So we generally want to fill in the bracket as best as we can without bumping you up into another bracket. So one strategy that you want to consider with converting is hunting for lower income years. Whether if you have years of lower income due to retirement, unemployment, any change of income, if you're a business owner, if you had good revenue one year, a little bit less revenue the next year, you simply just want to look for those lower income years and consider when is the best time to convert. Strategy number 3, we're talking about money movement. So we had a few questions about rolling over So this strategy here is going to be addressing the movement of money between one plan to another. There are two ways to move money from a retirement account. You can either do it indirectly or directly. The premise here, we're going to emphasize direct rollovers are a lot more efficient and typically better than indirect rollovers. It's not to say that you can't do an indirect rollover, but if you're going to be moving money from one custodian to another, one plan to another, it's typically better to do it directly than indirectly. Here's why. With an indirect rollover, what happens is the money is taken from the account and it's paid to you, the individual, right? And if you're the individual, remember, it's generally going to be taxed. If you're under 59.5, there may be a tax penalty. But with an indirect rollover, what you're doing is you're essentially putting it back into a retirement plan. So it's going to you, and then it's going to a plan. So this distribution is payable to you. You have a 60-day time limit. It's not 60 business days, 60 calendar days. You have a 60-day limit to put it back into some type of retirement account. But generally, when you're taking money out of a plan, like a 401k or something along those lines, they have a mandatory withholding. And you can only do a indirect rollover once per year. So that money that you indirectly roll back into a plan, you can only move that money once per year. Now, directly, if you directly move money from a plan or an IRA to another custodian or another plan or another IRA, instead of you being the middleman, it's going directly to the institution. So they're sent directly from the old account to your new account. There is no 60 rule. There is no 20% mandatory withholding. There is no once per year rollover rule. So again, if you're taking money out from a plan, know that you can put it back into a plan within 60 days, but you can only move that money once per year. With a direct rollover, there is no once per year ruling, and it goes directly to the custodian. So direct rollovers, what those look like is that the check is made payable to the company, but is made payable for your benefit. So it may say Cetera FBO client and the dollar amount. Although those checks may be sent to you, the check is still made payable to the institution. So even if you receive the check, there is no 60-day limit on getting the check deposited, other than banking limitations, right? You don't want the check to expire. But direct rollovers are typically made payable to the company, and they can be sent directly to the company, or they can be sent to you to send back to the company. Strategy number 4, coordinating your IRA planning. I'd say everyone can benefit from a proper coordination of how to effectively withdraw money from an IRA. When we're talking about coordinating, we're saying from an overall retirement strategy. You know, when is the best time to withdraw from the IRA at different points in time, but not just for your retirement income needs, but it could also play a role in your overall estate plan. If it's very important for you to leave that financial legacy to someone or some organization, it's also important to coordinate it from a tax planning perspective. As we talked about before, tax efficiency in retirement is very critical, but also in terms of funding education. If you're using an IRA or if you're using retirement to fund education for yourself, your spouse, any children or grandchildren, but overall, you do want to properly coordinate it with all the moving pieces. So it's not just what you own, but it's also where you own it. So strategically, you want to allocate certain investments in your retirement accounts and other investments in your non-retirement accounts to help lower your tax bill. We do have a quick example and a realistic story to give you an idea. So say you have two types of investments. 100,000 is in an IRA or some type of retirement account. And then you have another balance, another 100,000 that's in a non-IRA account. So now we're talking two different types of accounts. One's retirement, one is a regular investment account that's not a retirement account. For this example, you're in the 24% tax bracket. So your top earnings are taxed at that 24% rate. And let's say hypothetically you want to own 100,000 of investments paying a 4% rate of return, a 4% interest rate. And you want to own 100,000 of stocks paying hypothetical qualified dividends of 4% as well. So here we're talking about not just where you own it, but what you own and where you own. So in this example, 100,000 is in the IRA. The 100,000 that you have in the IRA, they're owned by stocks, so you're investing in stocks that pay 4% in qualified dividends. So theoretically, you're getting 4,000 in income generated from the IRA. But remember, money that comes out of an IRA is generally always taxed at ordinary income rates. So if your ordinary income rate is 24%, 4,000 that you're withdrawing at 24% means you have a $960 tax bill. Looking at the 100,000 in the non-retirement account. So this could be just a regular brokerage account, regular investment account, a joint investment account. If you own bonds that are paying 4% interest, same 4%, you're getting 4,000 every year, but those bonds are taxed at ordinary income rates as well. So bond dividends or bond interest is taxed at the ordinary income rate. So you see collectively what you're withdrawing from an IRA and what you're withdrawing from your non-retirement account, you're paying $1,920 in taxes owed. What if we just reverse the ownership? Still have the IRA, still have the non-retirement account, 100,000, 100,000, but this time the 100,000 that you have in your IRA, you're owning bonds. Honestly, that whole column is irrelevant because money coming from an IRA is always taxed at ordinary income, right? So whether you own stocks or bonds in the IRA, whatever income you're getting, whatever dividends you're getting, distributions from an IRA, they're always going to be taxed at ordinary income. The main story is on the right-hand side. 100,000 is owned with stocks paying qualified dividends. So because those qualified dividends are owned by stocks in a non-retirement account, qualified dividends are taxed at long-term capital gains. So long-term capital gains rates are lower than ordinary income tax rates. So where money from an IRA is taxed at ordinary income, in this example, 24%, long-term capital gains for someone in the 24% bracket is at 15%. So you're still getting the 4,000 in income from that non-retirement account, but the taxes on that is at a lower rate. So 15% of 4,000 is actually 600. So we were able to actually reduce your total tax owed on the income that you earn simply just by coordinating or strategizing what to own and where to own it. So a few limitations or risks, as always, as we're talking about investments, there's no guarantee that investments will perform as expected. Not all dividends qualify for taxation as long-term gains. So you do want to be familiar, again, where we specialize is tax efficiency with non-retirement investments. And then there's no guarantee that they won't change the long-term capital gains rates as well. So there, to everything, there's a downside as well. So coordinating IRA planning with Social Security, I'd say this slide is very challenging for most people looking at retiring and drawing Social Security early because Social Security is such a prized asset. I even believe that most people don't fully understand the value of Social Security. So many retirees don't properly evaluate the decision of when to apply for Social Security benefits, where IRA valuations are subject to change due to market fluctuation, market dropping and growing and accumulating. Social Security is essentially a guaranteed check that you can't outlive, right? So Social Security, the trade-off between guaranteed, even with the 8% for delaying drawing from your full benefit, it's a guarantee for life. So one thing you do want to factor in is what are the best ways to maximize your benefit for Social Security by coordinating when to draw from an IRA. Maybe it doesn't make sense to delay drawing from your IRA. Maybe you should spend that down first and delay drawing Social Security until later. Reason being, Social Security, again, it's money that you can't outlive. It's the cheapest annuity that you can buy in terms of price and the annuity bought. The bigger thing is taxes. With Social Security, up to 85% of your Social Security can be taxed based on federal and depending on the state that you live in. So at least 15% of your Social Security benefits you'll receive tax-free. And again, compare that to traditional IRAs, you may be subject to taxation on IRA distributions as well. Strategy number 5, this is going to be a little long-winded, so if you're still on, greatly appreciate you tuning in. I will say there may be a lot of questions that we get from this strategy here. So again, consult with me, consult with your estate planner. If you're, someone who works with an attorney, if you have a trust, if you have a will, allow us the opportunity to work with those professionals to really take a deep dive into your estate plan. Because there have been some rule changes on how people can inherit retirement accounts and their ability to stretch it over their lifetime. So IRAs and other retirement accounts generally pass via beneficiary. Please understand the hierarchy of beneficiaries compared to trusts, will, etc. It is critical that whoever you want to inherit money from your retirement accounts be properly appointed as beneficiary. There have been plenty of stories that I've even personally witnessed where the will says the money's supposed to go to the significant other, the spouse. The spouse wants the money to go to the spouse, but the spouse named the kids from the previous marriage to inherit the money. Guess where the money went? The money did not go to the new spouse. The money went to the kids, or the money went to the parents or whomever. But please understand, IRAs and other retirement accounts generally pass via beneficiary form. Make sure you update your beneficiary. Your will does not generally control who gets your retirement money. It may outline your wishes. Beneficiaries generally come first. So many people fail to appropriately update their beneficiary forms, leading to a lot of headache and a lot of bills for estate planning. There are different types of IRA beneficiaries. So again, following the Secure Act that was passed in 2019, it created this hoopla that we're seeing on the screen. So you have eligible designated beneficiaries, non-eligible designated beneficiaries, non-designated beneficiaries. These are start with the non-designated. Non-designated beneficiaries typically will be your estate. So if you do not name a beneficiary on your account, it will go to your estate, commonly associated with probate. So your money will go through probate. Court deems or identifies who the remaining parties are. After the assets go through probate, creditors get their first claim. Whatever is left will then be dispersed. Non-designated beneficiaries can also be a charity, and they can be certain types of trusts. Non-eligible designated beneficiaries can be non-spouses, so they're non-eligible to stretch it out or get special treatment. So non-spouses are generally non-eligible designated beneficiaries. Certain types of trusts can also be non-eligible designated beneficiaries, but your eligible beneficiaries are typically people who have the ability to stretch out or have special treatment on how they can inherit that money, which would generally be minor children underneath the age of 18, disabled or chronically ill persons. If a person is receiving or inheriting money that's not more than 10 years younger, i.e. a sibling, if siblings are close in age, certain trusts and spouses, they're all eligible. So what do we mean by eligible? Non-designated beneficiaries, if a person passes away prior to their beginning date of taking distributions, the non-designated beneficiary has to withdraw all of the money after 5 years. Again, if that person were not taking distributions due to RMDs and they pass that money to a non-designated beneficiary, that non-designated beneficiary has to withdraw the money over the next 5 years. If that person who had the IRA were taking RMDs, then the decedent's remaining single life expectancy is what they have the option to do. Pretty simple. We're just going to leave it at that. For non-eligible designated beneficiaries, so these were non-spouses and certain trusts, the account generally must be distributed by the end of the 10th year. The prior law used to be that the inheriting person, so if my parents passed, I inherit an IRA, I could either take it all out at once, I could take it out over 5 years, or I could stretch it out over my lifetime. That's what the previous law was. Now, since I'm not a spouse of my parents, thank God, I inherit the money. I now have to take all of the money out over a 10-year time period. By the end of the 10th year, everything in that account must be depleted. And you still have minimum amounts that you have to withdraw every year leading up to the 10th year. So most non-spouse beneficiary in certain trusts have to abide now by this 10-year rule. Why is that an issue? Why is that a concern? Imagine inheriting a large account. No one's going to complain about inheriting a lot of money, but inheriting a large amount and having to withdraw it over 10 years and be in peak earning years. Still, you get the money, can't complain too much. Dealing with the taxes, on the other hand, that's where it can be very tricky. So for non-eligible designated beneficiaries, this can be somewhat of a tax issue on inheriting non-retirement money that's subject to taxes. Focusing on the eligible designated beneficiaries, who are they? Generally your spouse, right? If you're a married individual and you inherit money, you're an eligible designated beneficiary. If you are someone who are disabled, or if you're leaving money to a disabled person, or someone who is chronically ill, or if that individual is within 10 years of your age, or if you're passing money down to a minor, they still do have the ability to stretch that money. So instead of them being limited to withdrawing everything in 10 years, they have the ability to stretch it out over their remaining life. So the stretch IRA is only eligible designated beneficiaries who can stretch the IRA. It does preserve the tax deferral for as long as possible, and it helps minimize the impact of taxes on those withdrawals. We talked about trust. I would say there is some benefit and some disadvantage to naming a trust as a beneficiary to retirement accounts, where you do get the benefit of control, avoiding probate, avoiding headache, argument, legal fighting, so on and so forth. In some cases, it may not be the most tax efficient way of passing money on. So again, consult with your tax professional, your estate professional, and your financial advisor on the most tax efficient way of leaving money to a trust. Now, for a spouse who's inheriting an IRA, you have a few options as a survivor of the deceding person. So options for spousal IRA beneficiaries, you have the spousal rollover option. You can treat it as your own account, or you could simply remain as the beneficiary of the inherited account. So in a quick example, we have Mr. Smith, who unfortunately has passed away. Ms. Smith is a surviving spouse. Ms. Smith has the option of either rolling it into her own IRA and treating it as her own. She can choose to inherit it as an inherited IRA, as a spousal inherited IRA. So in this case, she's going to move the deceased spouse into her own IRA. The funds are going to be treated as though they were always hers. Now, where this can be an issue is Ms. Smith is younger than 59 and a half, and she then needs the money. She will be subject to a tax and tax penalty on any money withdrawn before 59 and a half. So what may be better for her is to remain as a beneficiary. What she could do if she's older than 59 and a half is treat it as her own, and then she will be subject to whatever taxes are due at that time and whatever required minimum distributions based on her age. So it's not just when she can access the money, but it's also RMDs that you want to be considerate of. So an advantage to remaining as a beneficiary, so instead of taking it on as her own, she can remain as a beneficiary. So the inherited IRA assets are kept in a properly titled inherited IRA. The distributions, whether she's 59 and a half or not, or younger, distributions would not be subject to the 10% early withdrawal penalty. So remaining as a beneficiary may be a very favorable thing to do for someone who is younger than 59 and a half. And if she decides to then take it over later, so say she turns 59 and a half or older, she can then do a spousal rollover at a later point in time. So she can always come back to rolling it over and treating it as her own. So key important thing in today's time with cybersecurity, please watch out for scams. Generally, if somebody's calling customer service, IRAs are targeted for most scammers. Same thing for Social Security. So please be familiar with who you're speaking to when you're answering a call, responding to emails. If it seems sketchy, test it out to be sketchy. Find someone you trust, i.e. me. More than happy to help you out and be careful with scammers. So I'm always here to help. Thank you so much. This has been a long-winded presentation. Feel free to submit any last or final questions, comments, or concerns. But I do value your presence in our experience this evening. I tried to keep it as short as possible, but again, I thank you so much for sticking on this long. Please scan the QR code for a complimentary consultation following any of the information that you've heard today. And feel free to send any comments. Share this information with everyone. So I'm gonna pause the recording.